So we are going to talk about raising money in the long run. How do you raise more money? So we have a few folks here who raise a bunch of money and folks that are starting out. So this is a cool kind of mastermind or get together. And I will talk about my own experience and what I have learned from raising money, and then what I have learned from the people around us raise money. And I'll give also a couple customer examples. So a little bit about my background and why I might be qualified to speak on that. One is so my journey is I was a software engineer. I became a engineer manager, became a staff engineer, and then became an engineer manager. Worked at Amazon, Twitter, and Lyft. When I joined Lyft, it was about 300 people. When I left Lyft, it was 3,000. So went through the whole IPO phase. When Lyft went IPO, all my coworkers became multimillionaires, and so on. And I have five single families at the time, and I was ready to go into real estate syndication. I joined a mentorship group in 2018. In 2019, we have our very first syndication. The raise was a $4.3 million. I raised about 3.5 out of that 4.3. And we have 70 investors, $60,000 each. And my experience on that first raise is that it took us about a month and a half to 2 months to raise all the money. We were basically, we still had like $25,000 checks toward the end coming in, trickling after we close. And my manager actually commented that like, hey, it was kind of funny. So this is like a small set of people, can be very transparent. One of my direct reports gave the feedback to my manager, said that Perry was a little bit absent-minded the last 2 weeks. That was the feedback. I never received that feedback in my entire life. And so you can imagine how stressful it was. And even my parents say afterwards that they're like, you look different the last couple of weeks. Yeah, because I don't know if I could raise that much money. So that was 3.5 million. And the people who invested with me end up investing with us every step of the way. On the second deal, on the third deal, like 80% retention until like the fourth fourth deal, which is the economy was like really bad. And and then they invest into the startup and so on. So they did get a really good return. All our deals end up doing well. So, and then to put that in perspective, so the first one I raised 3.5. The second deal, it was a 408 unit. This is December of 2020. The first deal is July of 2019. Okay, so 2019, July of 2019. And then we close on September 2019. The second one is December of 2020. And then the next one is like July of 2021. And the next one is July of 2022. And then 2023 and 2024 decided I won't be a GP, a real estate GP anymore, because due to I want to focus on cash flow portal and I don't want that conflict of interest or perceived conflict of interest because I own cash flow portal. So this one is a $3.5 million raise. So 4.3, I raised 3.5 out of that. That was like 2 months. Okay. December 2022, I also raised about 3.5-ish. And that was like a $12 million or $13 million raise. But we have like two other lead GP. And so I'm one of them along with my business partner. And we raised about this $13 million about like 2 weeks. Yeah, 2 weeks. Yeah. And then the next one I did about 3.6 million. And then that was like 48 hours. So that's that. And then the 3.6 here was like a $6.7 million raise. And then the July 2022, that is the latest deal. And this is like I think this is like a $14 million raise. Yeah, that's a $14 million raise. And that's also 2 months. I raised about, I don't remember. I think it's like 3.6 out of that as well. So I think it might be 4 million at the time. Okay, so so the July 2022 was just extremely difficult because the interest rate and all that stuff and so on. Okay. And that at that time, I think the stock market just like dropped by crazy amount. Okay. So what have I learned? I have learned. So if you were to wrap all of this up, what is my experience? I will say lessons. It's um the people who invested with me um think I'm competent. I think that's one reason. And I think that kind of thing spills over across many areas. Um, the other thing, and then to double down on that, later on, I had a startup, and we also raised money. And later on, by the way, we Cashier Portal raised about $8 million across 3 rounds, and each time they were usually oversubscribed in about 48 to 72 hours. So I guess I do know how to raise money. And this thing about people who invest with me think I am competent, that they never tell me that explicitly. Nobody tells that to another person's face, but I do see anecdotes of that in other words. So to give an example, I think it's like I think there was like a whole message of like Elon Musk messaging either Larry Page or like Allison of like, hey, I am trying to buy XYZ or I'm trying to whatever. I don't remember if it's like buying Twitter. I think it was Twitter. And then the reply was like, hey, would you like to invest? And then there's like count me in for 10 million. Like it was a text message and he raised $10 million. There was never a pitch. There was nothing. There was just like a text message. Hey, you want to in? Yes, coming in for 10 million. That's how it works. And I think like later on, which is funny that we have a almost like investor relations person, and they join. They were doing some of the monthly updates on our behalf for our real estate. And it was like, oh yeah, I just post something on LinkedIn, and then so and so, one of my connections just end up investing 100K without talking to me. So yeah, in the later times, they don't really talk to me. They don't schedule a call with me anymore. They're like, hey, maybe tell me more about this deal. On the very first 4.3 million, every one of them is like an hour long of call where it's like, let me tell me about syndication. Tell me how about this works. Tell me more about, and it's the way you answer this question that really matters. And so I told the path of being quote unquote competent and reliable, and so there's that. And I think the other one is like people who invest with me think I have high integrity, or no, or they perceive that I have reasonably high integrity, that I'm not gonna take the money and then and run away. And that which is true, because on that $4.3 million raise, the reason that people took a chance with me was that I was living with housemates. So I have a 5 bedroom house. I live in one of the bedrooms, and then I rent out the other four. Now, keep in mind, at that time, I was at Live from 2015 to 2016 to 2021. That's when I was at Live. And so Live went IPO in 2019. And so and so when Live went IPO, all my coworkers became multimillionaires. And so but I was still one of those people that live with housemates. And so the assumption was that if Perry could live with housemates, given his own financial situation, he will most likely make this property work. And which is true, which is that if the property did not end up doing well, I might actually move into this Class C apartment just so that I can get the property on track. And so that's the lesson, which is what you have done up to that point matters on how much money you can raise. And so that's that. The other lessons I learned is that the first deal depends depends on your prior experience. Okay. Future deals depend on the track record of the first deal. That's my whole belief. And so we did we did a lot of work on that first deal. I did the math of like we are basically making minimum wage for the hour that we work. And that's fine because our goal is not to make money at that first deal, but to establish a reputation. And I still believe that. So what, the corollary of that is on your first deal, don't try to raise too much money. Raise some and then try to do a really good job. And then it takes about a year to show that you are on the right track. And then all your future deals will depend on the track record of the first deal. Okay. So that's that. And then, yeah, um, those are some of the lessons I have. Now, I'll talk about one of our customers' experience as well. So a customer A, I'm gonna anonymize the names. They are more similar to me, which is their friends, their LPs are also always their friends and their friends' networks. Okay. And they usually, and so that's one. And they have LPs that invested, 200K, 500K per check. And their LPs are all, went to Stanford or whatnot, and they are all even venture capital VCs. And so venture capital VCs tend to make money on their own fund and then take the money and then put it into real estate, which is more stable. So it's kind of like how pretty funny how everything works. And so they, and these LPs invest like 200K, $300,000 per check. And that's over the many, many years of reputation and track record. So that's the first thing, which is they're very similar to me, which is they develop a reputation for being competent and being able to find the best deals and being able to asset manage. But the second lesson I learned from them is that even though they can raise a lot of money during these times, they also tap out around $7 to $8 million. So that's a very interesting insight, which is no matter how big your kind of network is, your friends and family and their friends network usually can go only so far. And you cap out 7 to 8. Now, just to be clear, 2 years ago, they can raise 15, 20 easily, but now they can raise like half as much. So the other lesson is the economy, the macro conditions play a bigger role than one thinks. And I got a taste of that in 2022. Like, remember, like we came off this 3.6 in 48 hours. And so like, how hard can that be? But it took me 2 months to get to 4 million a year later. Well, I realized that it's not because of me, it's because of the economy. They just lost like 60% of their net worth on the stock market. And it's like a falling knife. And they're like, you getting it on this such high interest rate, da da da. And I don't have the money. I'm in shock. I'm recovering. And with those people, we are very, very polite. We just let it be. And a year later, they invest in our startup and they ask me, it's like, hey, now I'm back. Do you have more opportunities? So I refer them to other GPs because I was no longer a GP. So it turned out that the macro conditions actually play a higher role than you think. It's not because of you. Sometimes when you have done everything you can and then you're competent and you're high integrity and you're communicative, it's probably not because of you. It's because of something else. Now, you can never know without self-introspection, but there's that. So that's the customer A's experience. Let's talk about customer B. Customer B is different. Customer B is like 20% of their LPs are their own network. Okay. And then the 80% is through a marketing machine. So they're like high SEO, going to conferences, have a community, have a mentorship group, they have their own mentorship group. They're helping kind of strangers and give enough value to get investments back. But what I have also observed is that the deal to deal retention is lower than customer A. Yeah, and then check sizes are smaller. And this, I think it's because customer B gives off this vibe of like, I am not really, I'm not really paying attention to you, my own LPs. I'm always, because if you go on my Instagram or Facebook, I'm always focused on the extra, the new LPs. And so the existing customers just like, yeah, you're not really paying attention to me. You are like trying to expand. And so sometimes they will invest less, because they feel like they don't get the full attention. However, customer A and customer B, they are both doing the right thing. Customer A is gonna look at B and like the grass is greener on the other side because I'm capped at 7 to 8. And the only way to do what they do is to have some kind of community or mentorship. The B is looking at A. Well, I did what you did and I got stuck. That's why I'm creating a mentorship and creating a community. Both are right. And I'm definitely on the customer A side, which is that's my experience. I never had a mentorship and right? And I don't like having an educational group and whatnot. Although I do like helping people and teaching and so on. Um, which one is more right? I don't know. Duke, Chris, and Paul, what do you think?
Yes, so my experience, especially when you're starting out, is your ability to raise money is largely determined by friends and family, your personal network. So, that's my experience. And then as your reputation grows and people start talking about you at cocktail parties, right, and you get more of a reputation, then you can transform into a little more of what customer B is like. And then it really depends upon what type of mental makeup are you. Some people are more outgoing, so you could be more like customer B. It's just natural for you to go out there and prospect. Where other people, just don't have that gift or that skill set, and so they're going to wait for more people to be more of inbound, right? Inbound marketing versus outbound marketing. I myself, very hesitant to go out there and prospect. So I'm almost all inbound marketing. It's only after I know someone for a while and I develop that relationship that I feel comfortable going for an ask. If it's a Unless somebody refers me to one of their friends, or somebody hears about me, then I would meet with them. And that's just me personally. Other people I know are just kind of natural born salespeople, and good for them. I am not that person, so I feel very uncomfortable approaching strangers, asking them for money.
100%. Yep. I love that. I love that inbound and outbound. It's a business, and um, I love that. I think a lot of the syndicators got into this field and they like it because there is the first time they're operating a small company. And all these terms that apply to a regular company like marketing, sales, SDR, like they actually have a correspondence in a private equity firm. Yeah, I love that. And yes, I am 100% inbound person, which kind of limits the type of the amount that I can raise. And so that's why I don't think I was born to be a private equity firm. I was born to learn the experience so I can develop software that can serve them, but I am not that extroverted person. Yeah, 100%. Chris, what do you think?
I was actually curious, do you think there's any sort of cap on that customer B side? Where you said there's a 7 to 8 million kind of sticking point depending on the economy. Do you think there's any sort of sticking point with the customer B, maybe just not being able to teach enough people quick enough? Or
Yeah. So sticking point meaning that is there any limit to is there any downside to customer B's approach?
yeah.
Yeah. So the answer is okay. Uh, welcome, David. We're talking about raising equity, and I was talking uh that I raise money based on the fact that I hope that I'm competent and have high integrity. And then there's the customer A's experience, which is they raise from their friends and family. And then there's the customer B's experience, which is through kind of outbound marketing, creating mentorship, creating a buzz. And then Chris's question is there any downside of customer B, of customer B's experience? That's a great question. I think there's the tactical downside, and then there is a psychological downside. Okay, psychological downside. The tactical downside is that you have to put yourself out there. Okay. And then the other tactical downside is that it's a upfront investment. You have to create a team. You have to create a team and a branding and presence and so on. That the other tactical downside is that it may not end up being efficient, right? It's like you may be creating a maybe 2x bigger business in terms of the amount you can raise. Let's say by doing so, you can raise 20 million, right? Instead of say 8 million. But I don't see a lot of people raising 40 million by themselves. I see rarely. They still use like fund managers. And so, and and so the tactical downside is you create a 2x business and it's only 2x because $50,000 cannot be bought by marketing. Ha, that's a good quote. Like someone investing $50,000 with you cannot just be like if because of your ads. It's because they actually want to work with you. And so, no amount of marketing actually end up being that effective. And as a result, you are spending a lot more money to create a 2x more business going from $8 million to say $20 million, a little bit 2.5. And so it's a worth it. And so it ends up being like not very efficient. You're spending you raise like $13 million more and you are spending like $1 million each year on marketing, like through the different mentorship groups and so on and so forth, right? So I'm giving an example, but you can see that's the tactical one, which is you expand the pie but not as much as you thought. The psychological downside is that you are now more responsible. People will blame you if something goes wrong. You can come across as like ruthless and ambitious and like territorial. Like I think a lot of the big gurus out there have that kind of vibe, whether they want to have that vibe or not. And so if you are not that person, you can feel bad about yourself. It's like, oh, people misunderstand me. I'm actually not. I'm just doing it out of the business necessity and so on. And they have this vibe of like we are going to like take over, Southeast, US and have conquer this town or and so on and so forth. I'm gonna buy a lot of like 10,000 units by end of the year, da da da. And that's the psychological downside. And then there's kind of like the bad publicity. When you're successful or you're not successful, when you're big, people are just gonna talk about you. And so that's gonna weigh on you. When I look back at our customers, the people that are customer A, nobody knows them. But they're raising just as much money as the ones that like everyone knows. It's crazy. Um, but you know what? The upsides of customer B is that you creating a lasting legacy and you are in the frontier of this industry. Yeah. So um there's a psychological downside and then there's the psychological upside. The upside is like feeling like you are uplifting others. And then the other upside is like making a difference and then like frontiering. Usually they are like more tech forward and then more tech forward and then like create a corporate process, an enduring legacy. As in like they can quit their job and then someone else may be able to take it over and that is still a private investment firm. So that's a very, very big upside. You're creating a business that even without you, people may not know who's the founder anymore, but that this private equity firm can live up. Yeah, that's actually a huge upside. Yeah. Whereas with this one, like there's no way that like customer A's experience, they're done. Like after they're just mom and pop, and if they retire, they retire. I am A, right? Because after I start raising money, the company doesn't continue um on my real estate journey.
I had a quick question also about when you're talking about the beginning of your, if you could scroll up at the beginning, you're talking about your first deal versus your like most recent. Would you say um the same people were investing the same amount, or do you think the same people were investing more? Basically, like, were people willing to give more and more money, or did you realize the same people that invested a certain amount were kind of only willing to keep investing that amount?
What do you think? If you have a guess.
I would think um they would invest more, but not as much as you might think.
Yeah.
So you wouldn't have someone who invests 50,000 invest 200,000. maybe become 60, 70, 80,
Yeah,
but
yeah, yeah.
I
Cool.
think it would kind of cap out there.
Yeah, great question. I think the short answer, the elaborate answer is it's a mixture. When they invest more, they invest a lot more. And then there is maybe I'll say 50% invest a tiny bit more. So like going from 50K to 75K, um, and then to say 100K. And then there will be like 10 to 25% invest a lot more. So I have this person that invests like 50K on the first check. The second check they did 250K. And then the third check is like another 250K. And then the fourth check is like 375K without talking to me on any one of the later ones. It's stupid. um, yeah. So the lesson to those folks, you don't know who they are. All you know is that they're stack. You do know that, but you shouldn't count on it. All you can do is and it's not like you go on one-on-ones with them throughout the journey and like, hey, how's your experience, da da da. It's all in the weekly and the monthly emails that you send out. They read it and they're like, okay, this person, um the devil is in the details. If you're late on your monthly updates, they're not gonna invest, and they won't tell you. And you're like, oh, why is it that I don't get more investors? So I will say, just like any good business, what is your retention? If your retention is good, you are probably on the right track. And they won't tell you why you fail some customers. All they will say is they wouldn't, no, they're not as interested in the later rounds. Yeah, and people are busy, so there's a bunch of signal going in. There's a bunch of other factors as well. Yeah, but yes, we have seen now. Everyone's mileage might be different because I am grateful and blessed that I happen to be in a pre-IPO company that end up doing well, but that's not always the case. So just because you don't see it doesn't mean that you're not doing well. It simply could mean that you just don't have that investor base yet.
Yeah, so going back to the types of customers, we had always raised under a Form D 506B. You know,
Yeah.
we can't advertise, right? It's kind of in-house network, word of mouth. And then coming up, we're going to do a 506C. So, you know, more of kind of customer B experience, almost forcing myself to get out there and prospect and attempt to raise larger sums of money.
Mm-hmm. That's right. Yeah, great. Cool. All right. I think that's that. Chris, what do you think? Any more questions?
Mm, no, I think it answers a good because I'm always curious about these big mentorship groups and like what's like the real reason behind it. Because obviously they're gonna say they want to teach people
Yeah.
because of the goodness of their heart, but there's got to be a reason, right? So
Mhm.
I guess a big reason is um I guess two actually. I would say one bonus is you teach people about syndication, so when they if they do invest with you, you have to teach them less. And
Mhm.
the second part is the people who do want to be GPs might
Mhm.
bring you deals and want to work on deals and kind of it's like it helps like twofold, I guess you would say, right? So you're training your investors to know about the stuff and
Mhm.
then also future business partners for other deals.
Yeah, that's a correct statement. Yeah. Um. Oh, Paul says, Garashi law firm has good webinars. Oh, that's good. Okay, very good. Okay, I'll remember that. I'll check it out. Thank you. Yeah.
Yeah. They're free. So just like this, right? They're more educational, and then on the back end, they're hoping that perhaps you use their law firm, but there's really no pressure there
Mhm.
to use their law firm. They're there for if you need them.
Yeah, I love that. Thank you. I do think that will be a way to look at syndication. Yeah. However, I will say I know folks who are successful in mentorship groups, and some of them are actually really good. I think they are really kind, and I know that they are kind because I went to some of their masterminds, and their whatchamacallit, their staff love the owner, and their staff can like joke around about the owner, and so that's like that shows me a lot about their character and so on, and so I like them, um, and some of them also said to me that like if I really want to get wealthy, I could just buy a lot of thieves, but instead I focus on mentorship. So they are surrounded by people who have, private jets and bought a lot of these and do property management and so on. And then they are actually quote unquote less wealthy. And if they want to compare, technically being a teacher is not as big as just going and buying more thieves. And they ask why, and they say it's because I really actually like teaching. So there's that. Obviously, so that's that. So I think there's a little bit. So my opinion on that is, if you're only doing it to get more kind of like LPs, you're probably not successful. And so there is that element of like, I think that's what they're good at. Yeah, so that's what I'll say. To give another example, why am I doing this, like webinars and so on? And I think I need to do a better job of like inviting people into a calendar event so people like know that this is happening. Thank you folks for putting it on the calendar. You could also argue that we're doing it because we want to get more customers and so on. But my reason is actually more to articulate certain things so I can be a better speaker or be able to, when you verbalize your knowledge, you become more of a expert on it. And so that's helpful. Yeah. Yeah. So I think there's definitely a little bit of like, I'm spending my time in that direction because they do intrinsically like it to some extent. Yeah. Yeah, so that's that. All right, cool. This is gonna be a shorter call. I need to go to the airport to catch a flight. But thank you so much, everyone. Thanks for this.